Welcome back, everyone. I'm Severino, your personal business coach, helping you on your way to financial freedom as quickly as possible. My own portfolio went from minus $50,000 to today $1,075,000. We will check it immediately, and I will share with you one gem that I've been finding that you might not even be aware of. It's called Moody's, and I want to really show you the mechanics, why I decided to buy this company, and let's see if it fits your current criteria for your portfolio. This is not financial advice, it's sharing my own research so that you cut time in your own research and in your own decisions. My portfolio is today at $1,075,000. The plan is to double the net worth every 3.8 years. So far, we are on plan. We are in the fourth doubling that I'm doing here live with you guys. The plan is we want to double again in 2028. So this number here should be 2 million in 2028, minus some lifestyle chips that I will take out. But overall, we want to be at around 2 million in 2028, and this is the plan. The target portfolio is made of companies that are owning the relevant data that the planet needs. They have high pricing power, and they are capital light, because capital light means they're highly predictable and easy to run. So we will screen them by the ones that are data owners, have high pricing power and network effects, and are capital lights, and then we will look at the number. Today, I want to share Moody's with you. There's this pretty cool story by Warren Buffett about Moody's where he says, I don't want to be their customer, but I have to. And this is exactly the strategic positioning that you want to have, right? Even if the customer doesn't want to buy, they have to buy. Well, he has some optionality. It's an oligopoly. Let's go in there. So does he really have zero option? No, he has two more options. He can go with a ratings company called SPGI. He can go with Fitch, or he can go with Moody's. Those are the three things. If you want money, dear Warren, you have to get a rating so that we will know what taking that money will cost you. Now, if we go without a rating, it will cost you much more. So pay $100K to Moody's or SPGI and Fitch, and so pick one of those three, pay them a couple $100,000, and you will save more than those couple $100,000 when you get your money. That's the point. So you see high pricing power, because whatever they tell Warren, as long as it's below what he has to pay for, he will pay a couple grand easily to get money cheaper. So it's a win-win-win situation, and even clients who don't want to buy their services will buy their services. So we have this oligopoly situation. The offer that Moody's have is essential for credit markets. Credit ratings are essential for the functioning of debt markets. And what is our world built on? Debt. I would even add it's built on debt and data. But so far, the last 2,000 years, our world was built on debt. I don't think it will change anytime soon. I think the next 2,000 years, it will be based on debt. Just look at your government and what it's doing. It's increasing their debt. So credit ratings are essential for the functioning of debt markets. We live in a world that's built on debt. They provide a standardized measure of risk that facilitates lending and investment decisions. Do you think in the next 15 years lending will stop? Nope. So pricing power. There are limited alternatives for the clients. It's a subscription-based model, so high pricing power. They own proprietary data, and you know my thesis, data is the new oil. So they have accumulated vast amounts of data, financial data, economic data, over decades, which analysts use to de-risk. They have analytical capabilities and huge analytics teams. Debt issuers, governments, corporations, rely on Moody's ratings to access capital markets. Do you think people will stop wanting to access capital markets? And then how easy is it to enter and to steal Moody's market share? Well, the barriers to entry are enormous. There are regulatory modes. Credit rating agencies operate in a highly regulated environment. It's not easy to enter from the outside. There is a methodological complexity in there because replicating the infrastructure that they've built would take you 10 years to do. So they're always ahead. And there is reputation and there is track record over decades. So those are all strategic advantages or moats. We double check them. Are they data owners? Yes. Pricing power? Yes. Network effects? Yes. Are they capital light? Yes. Do their clients have high switching costs? Enormous. Now we have to go to the numbers. We want to see three things increasing: the free cash flow per share, the operating income, and the return on capital employed. Let's see if this is the case. Operating income, yes, increasing over the last 10 years and even accelerating recently. Free cash flow per share, increasing over the last 10 years, accelerating recently. Return on capital employed on an annualized basis, overall up and accelerating since 2 years rapidly. So we are on track. A GF score of 91 out of 100 is pretty good. We have strongest profitability, strongest growth, high momentum, and it's even fairly valued right now because the fair value is $374. So we are at fair value right now. And then the last double check, I am humble enough, even if I think that I am right, I always know I can be wrong and I will be wrong. So I double check with other people who do this for a living. The super investors that have big teams of analysts, what do they say? Well, in Q1 2024, 1.7 billion were bought by 5 super investors. And those have decades of showing that they beat the markets, and they have smart analysts doing nothing else than double checking exactly these assumptions that I've just shown you. So Joel Greenblatt went in, Ron Barron went in, Ray Dalio went in, Chris Hone, and Chuck Aker. These guys are legends. And if we just double click into one, Chuck Aker, he is the guy with the 3-legged stool. He only invests in companies that meet his 3 criteria: great management, great profitability, and great runway. So I feel that our thesis is validated. I will check every week that the thesis is validated, but Moody's will enter my portfolio, guys. So I have decided that I will invest into Moody's. Let me know how you evaluate the company. What's your fair value estimation? And is it something that will enter your portfolio? Let me know in the comments, and whatever you need next, guys, let me know. I'm happy to do a video about that. Meanwhile, enjoy your dance to financial freedom.